Hi everyone and welcome to Symax Fintech Weekly Market Insight. Starting with our disclaimer, so trading involves the potential risk of loss of capital. It's not suitable for everyone. Hopefully it is for you though. Many companies provide you with leverage, so just be careful because you can lose substantially more than that initial investment that you make. The news, views, everything that we add into these is just purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And of course, before you make that decision, you should carefully consider the risks, your financial situation, definitely your level of experience, and of course, your risk appetite. It's important you only risk capital that you are prepared, but more importantly, that you can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you risk that capital. Okay, so last week, very exciting. We saw lots more central banks hike rates again for the end of the year. The Fed, the Swiss ECB, Bank of England, they all raised by 50 basis points. Norway, I think it was only 25. And of course, the market sort of reacted to all of that, but then there was more data that came out afterwards. And the US inflation data was lower than expected. The headline was only 7.1 and the core 6%. Consumers starting to reduce demand. And that's being seen in retail sales and also in the manufacturing data. However, some food, like the commodities, did rally. It really was a week of two halves, though. Investors felt good until Powell repeated that inflation must be beaten. Remember, I've been warning of this week after week for you guys so that you're prepared for this and you don't get too excited. For the dollar weakened and then recovered as the week went on. And of course, especially as we got towards Friday, the dollar strengthened up quite a lot on Friday. Stocks tried to rally, but then again ended down on the week. Oil's just oil. It continues to be volatile. There's so many sort of positive, negative factors around it at the moment that's impacting it. It could still go either way over time. Russia escalated bombing of Ukraine, including Kiev, which they haven't done for a while. They're targeting the utilities, water and power. They're really sort of trying to impact that infrastructure. At one stage, Kiev, I think there was about a third of it without any power last week. China continues to ease the COVID measures. They've got a record number of cases, though. So, it's difficult to gauge why they've decided to do it now as cases are increasing rather than when they were sort of very low. And for me, it's destined to get worse. Those cases are going to increase. But on the other side of it, you can understand it. They see the rest of the world sort of pretty much just going about their business, just living with COVID, as it's stated. But it's understandable when you look at their data. It's been pretty poor. I mean, their retail sales was down 5.9%. Here in the UK, house prices dropped 2.1%. That's just month on month as well. And GDP was better though, so it was up 0.5%. So that keeps it out of a recession for the moment. Manufacturing also improved. Unemployment rate was unchanged at 3.7%. It's the same as the US, so it's not so bad. Our inflation levels are higher though, but they were down, which was good to see. Just down not enough. So CPI headlines 10.7% and the core 6.3%. And that's comparing with the EU. They got 10.1% and a core of 5%. And in New Zealand, GDP was higher. So every other meeting, the Fed provide these dot plots. So this is it's once each quarter. So this is the latest one that came out this week. And it just does reflect the expectations for what they see going ahead. When we go into next year, still a bit higher. I put below the averages of where the expectations are for them each year. So it's looking like 5.1% next year. So 5.25 basically. They just take the mean of that. Uh, are they going to stop there? We'll have to wait and see. It's really going to depend on those inflation. Inflation coming down sounds amazing, and it is for us, the consumers, because we need it for sure, because it impacts our disposable income. But it's coming down very slowly. And again, that's being reflected, and Powell sort of is really trying to make people wake up to the fact that they're not going to change policy anytime soon, possibly not even in 2023. They need to beat inflation. Okay, so key data of this week. It's the last week before Christmas now. Just in case you didn't know that, of course. But what we say as pro traders, for this last 2 weeks of the year, it's really for the needy and greedy. However, that said, there's going to be lots of opportunities this week, but you've got to expect volumes lower and volatility higher. So just be careful of that. In the US, we've got housing data, consumer confidence. Again, we account for 60–70% of the economy, so that's important. The Fed's favourite metrics coming out this week, PCE. So keep an eye on that. That will move the markets. GDP, durable goods, consumer sentiment rather. They're all very useful for looking at for when we start to assess what's going to happen in 2023. Durable goods is a good one as well, because I don't know if you know, but that's something that has a lifespan of at least 3 years, or its expected lifespan. So it's more like your sort of household goods and stuff like that. Now, they're the bigger ticket things. So if people are buying them, it means they got confidence with their earning abilities. If you see durable goods dropping, then that means people are becoming a bit more concerned, and they're not willing to make those bigger purchases. The UK, we have GDP, the EU consumer confidence, so they're a bit light on data this week. Then Bank of Canada CPI. We've got a rate decision coming from PBOC, so China's rate decision. Expect that unchanged still. Then Royal Bank of Australia, we've got the minutes from their last meeting. And then again in Japan, we've got another rate decision, but we should expect that unchanged, although inflation is creeping slightly higher there. Moving on to the macro outlook. So what does 2023 have in store for us? Interest rates, for me, they still have a little bit further to go, and then they're just going to stay there. They're not going to drop. There are a lot of people expecting, oh, okay, so I finished putting rates up, so they're going to put rates down. No, not going to happen. For me, they're going to stay there possibly for the whole of 2023 at those elevated levels. They need not just to beat inflation, because that's, inflation is stubborn at the moment, but they need to beat it, but they need to make sure that it's going to stay at their desired level of this 2%. And that means that if it gets to that they're going to want to see it stay there for 3, maybe even 6 months, to have the confidence that it's, that they've got control of inflation again. And even when any rate cuts come, unless there's something dramatic in the way of a crisis, but I still don't believe in zero rates anyway, then you're going to see smaller incremental lowering of rates. It's not going to be a fast thing, and central banks will do it on a wait and see approach. It will depend on the data. Inflation's got to come down before the central banks stop raising rates. They'll slow them down. They may only go up in quarters. The most of the big work's been done now, but they're going to stay there. They're not going to come down. And it does give them that tool of being able to tweak rates to try and influence the way we either spend or save as well. Um, for me, inflation's really spooked the central banks, and that's going to give them more to think about at the next crisis. Cutting rates back down so quickly, doing quantitative easing the way that they do. They really need a plan B. They really do. And so it's going to be a long time before they consider any policy changes. You can expect stagflation in some countries. In case you don't know what that is, that's inflation but without any growth. And then, potentially that's going to lead on to recessions. Again, different countries, it's going to differ between them in depth and length of how long those recessions will be. And in Europe, the weather will probably have a part to play in that. Now, although supply chains have been improving and inflation dropping, we now have to consider the reopening of China. Okay, so COVID cases, some cities seem to be almost empty, where workers are self-isolating. And of course, what's happening now is some of the companies are actually keeping their staff on the premises to try and prevent them from, obviously contracting COVID. Now, for me, there is the possibility that it will increase demand because they're coming out of their lockdowns. I mean, just look what happened with the rest of the world. I mean, demand went crazy for a while. But then, boosting inflation is then going to give another problem to the central banks, because if that demand from China sort of spreads out around the world, that's going to give inflation another boost. So, on one side, you hope that supply chains will improve, but if everyone's got COVID, then possibly not. They have got more people vaccinated, but not enough. So there's good and bad. There's positives and negatives to be taken from that. Moving on to Russia. So Russia's trying to break Ukraine by targeting their utilities, their water and power. And of course, with the weather being so cold, their troops, it's difficult to move their troops forward. And obviously, Ukraine's been having such a lot of success regaining ground that this may remain Russia's strategy over the winter even. Obviously, it depends if they've got enough of these drones or whatever they're going to use for these bombings, etc. Energy prices, because of all that, have been a bit erratic. And even now, okay, October, November were quite mild in Europe, but December's really sort of dropped down with those temperatures. I'm in the UK, we've even seen some snow, and I'm sort of just outside London. I'm not up the north where they usually get to see that. But the temperatures have dropped fast, and in the US as well. Even New York had a lot of snow quite recently. Now, the cap on gas may come soon, as it did for oil. The EU's put this maximum that they're prepared to pay for oil of $60 from Russia. And of course, now they're trying to create the same situation with gas prices as well. Oil you can sort of source from a lot more places than you can the gas though. So whether that works remains to be seen. So food prices continue to increase slowly, nowhere near where they were earlier in the year, but they are moving higher, especially over the Christmas period, because everybody knows that people need to go out and buy their special foods and such like. There's still that lack of workers. Again, comes back to the baby boomers retiring and such like, or sort of mid-senior managers in their 50s, 60s just not wanting to go back to the office. But there's different sectors again. So in some sectors, they're trying to hold on to their staff because it's been so problematic in finding them to start with. The areas that are sort of really starting to shed jobs are obviously the tech that's been doing it for a while, followed on by crypto, and more recently, the banks actually doing some job cuts as well. And you can see that because jobless claims are slowly creeping up. And I expect jobless claims to go higher in 2023, throughout 2023, really. So this is going to be our final YouTube for 2022. I hope you've found them insightful and useful. More importantly, I hope they've helped you make money, or at least stopped you from losing it. Now, on today's YouTube, there's still more to come, trading tips and analysis. But, this is just sort of, really it's time for, the thoughts now on what's going to happen next year. So, you need to be sort of thinking about your plans for next year. But what I do want to do now, so I don't forget, is to wish you all a Merry Christmas and a happy and prosperous New Year. And also wishing you health, wealth, and happiness.